The gold to silver ratio didn't just drift lower tonight. It jolted violently downward, and that sudden sharp movement is exactly why you need to pay attention right now. In the most recent stretch of aggressive trading sessions, silver's strength has started pulling the ratio downward fast enough and decisively enough that single-digit ratio levels are no longer internet memes or fantasy talk. They're becoming live, realistic scenarios that serious market participants are actively planning for. And if that scenario continues unfolding the way current momentum suggests, the market isn't simply preparing for another normal cyclical uptrend. What we're witnessing could be the early stages of a full fundamental repricing of silver relative to gold and relative to fiat currencies. Here's exactly what happened in clear terms. Silver pushed into a dramatically higher gear of performance. The gold to silver ratio started compressing at an accelerating pace. And the conversation among informed traders shifted from asking whether silver is moving at all to asking how far silver can outrun gold before the mainstream crowd finally notices what's happening. Because once the general crowd notices and starts participating emotionally, the character of the move almost always changes. It gets louder, faster, more volatile, and dramatically less forgiving to those who don't understand what they're doing or why they're positioned. Before we dive deeply into the mechanics, the levels, and what this means for your positioning, I need to address something directly that affects this entire community. I'm actively running a campaign to eliminate and expose copycat channels that recycle original research, steal content, and confuse new viewers who are trying to find authentic information. If you genuinely value the work being done here and you want to support original analysis, I need you to hit the subscribe button right now and leave a comment that says OG John AG so I can immediately identify and recognize the real supporters. My YouTube analytics also show something frustrating but fixable. A massive percentage of viewers watch these videos regularly, benefit from the information, and still haven't subscribed. I'm not angry about that, but I am directly asking you to help me keep building this platform by taking 1 second to tap subscribe. That one action makes a much bigger difference than you probably realize. Additionally, because I want to stay closely connected with the real engaged audience, I've opened a dedicated WhatsApp channel where I drop daily market updates, quick urgent notes when market conditions flip suddenly, and direct links to each day's video so you never miss critical moments when timing matters most. The link is sitting in the description below. Keep it simple, join that channel, and you'll consistently be ahead of the headlines instead of reacting to them after everyone else already knows. Now let's jump directly into the core question everyone is asking. Why is everyone suddenly talking about a 7-to-1 gold-silver ratio, like it's a countdown clock ticking towards some inevitable event? Because the gold-to-silver ratio is not just another chart or indicator you glance at casually. It's a pressure gauge. It measures relative strength, relative demand, and relative scarcity in real time. When the ratio falls, it definitively means that silver is outperforming gold on a percentage basis. And when it falls hard and fast over a compressed time frame, it almost always means that silver isn't just participating in a general precious metals rally. It means silver is leading, and leading aggressively. Most casual investors and even many experienced traders treat silver like it's simply a cheaper, smaller version of gold, like a little brother metal that quietly follows along wherever gold goes. But that perception is fundamentally wrong. Silver is a completely different animal, with completely different supply and demand dynamics. Gold supply is primarily gold supply. Miners go into the ground specifically to extract gold, and that's what they get. Silver supply, on the other hand, is structurally weird and deeply misunderstood. A massive portion of global silver production is not mined because someone wanted silver or targeted silver deposits. It's mined because mining companies wanted copper, lead, zinc, and other base metals, and silver just happens to show up as a byproduct of those operations. That one structural detail changes absolutely everything about how silver markets behave under stress. Because if investor and industrial demand for silver suddenly spikes, the mining industry cannot simply flip a switch and flood the market with massive new primary silver supply to meet that demand. The vast majority of silver production is structurally chained to the economics and production decisions of completely different base metals. So even if silver prices scream dramatically higher, the supply response is slow, complicated, messy, and fundamentally limited by factors that have nothing to do with silver itself. And that's exactly when price becomes the primary release valve for the imbalance. This structural reality is why ratio collapses can be extraordinarily violent and why they can overshoot dramatically beyond what seems reasonable. The ratio isn't only measuring relative value between two metals. It's simultaneously measuring stress in physical availability, stress in market sentiment, and stress in trader positioning across the entire complex. When the market begins sensing genuine tightness in silver supply while gold remains fundamentally strong, the ratio can compress faster and further than most market participants can emotionally handle or financially survive if they're positioned incorrectly. Now, I know a lot of you watching this are quietly thinking the same question. Okay, but is it too late to get involved now? And that question, while understandable, is usually a clear sign that you're looking at the wrong scoreboard and asking the wrong framework question. Late for the first leg of the move? Possibly, yes. Late for the entire multi-phase move that could unfold over months or even years? Absolutely not necessarily, because parabolic markets do not pay participants evenly over time. They pay in concentrated bursts. Early on in a major trend, the move feels agonizingly slow, boring, frustrating, and annoying. You watch your position go nowhere for weeks or months while other assets seem to be moving. Then suddenly the market flips into acceleration mode, and the exact same price action that bored you to tears starts sprinting vertically. That's the fundamental law of parabolic price movement explained in plain everyday language. Returns compress into shorter and shorter time windows as the trend matures and gains mainstream attention. And when that compression phase begins, your single biggest enemy is not the market itself or some external force. It's your own psychological impulse to chase emotionally at exactly the worst possible time. Here's the part that people genuinely don't like hearing, but it's critically important. The closer we get to major psychological milestone levels, the more genuinely dangerous leverage becomes for most participants. Not because the long-term fundamental idea is wrong or dead, but because the path forward gets dramatically rougher. Pullbacks get sharper and more violent. Fake breakdowns designed to trigger stops get nastier, and the market can systematically wipe out over-leveraged positions even while the bigger underlying trend remains completely intact structurally. So the smarter and more sustainable framework for navigating this environment is this. Hold a meaningful core position that you can stomach emotionally and financially through extreme volatility, and then use a separate smaller tactical layer for adding on significant pullbacks and trimming into euphoric rips higher. That way you're not all in emotionally, where every tick controls your mood, and you're not completely all out sitting on the sidelines when the major continuation move happens. You're actively managing a strategic campaign, not buying a binary lottery ticket and hoping. Now let's talk directly about why the single-digit ratio obsession creates so much energy and emotional heat in precious metals communities. When the gold to silver ratio gets into single digits, the narrative fundamentally changes across the entire market. The casual crowd stops debating whether silver is interesting and starts watching obsessively. And when enough people begin watching the same thing at the same time with the same expectations, markets very often overshoot dramatically in both directions. Overshoots are where the headlines get made. They're where silver can sprint past levels that feel completely unreasonable or unsustainable. Not because price will stay at those extreme levels forever, but because the market temporarily has momentum, scarcity anxiety, and positioning stress all hitting simultaneously. And yes, ratio overshoots absolutely can and do happen in both directions throughout history. People confidently say it can't possibly go to 7, and then it goes to 7. People say it can't possibly go to 5, and then it taps 5 briefly. Does it live there permanently? Usually not. But simply touching those extreme levels can be enough to shake and restructure the entire precious metals ecosystem. Now, there's another critical angle that makes this current setup particularly dangerous for casual, uninformed investors. The narratives and stories that get aggressively pushed the exact moment that silver starts decisively outperforming gold. You will hear the same predictable playbook repeated across financial media. This is definitely the top. This is clearly a speculative bubble. This is your last chance to get out before the crash. And sure, parabolic moves absolutely can end violently and painfully, but pay very close attention to when those fear-driven narratives get loudest. They almost always arrive precisely when regular retail people finally start paying attention, because fear is the single easiest and most effective psychological tool to shake weak hands out of winning positions. If you've watched any market long enough across multiple cycles, you already know the repetitive sequence. When an asset is quiet and boring, nobody in mainstream media covers it. When it starts moving with some momentum, headlines begin appearing. When it starts making ordinary people real money, warning articles and bearish opinions flood in from every direction. And when the move becomes completely obvious to everyone, volatility spikes dramatically. That's exactly why I keep repeating this. Don't trade headlines or narratives. Trade structure and behavior. Structure is the difference between a real sustainable trend and a fake head fake move. A real trend consistently holds higher lows, recovers quickly and aggressively after dips, and keeps reclaiming key technical levels. A fake trend pops once and then bleeds sideways or lower for weeks. So if you want the cleanest and most reliable read on what's likely coming next, focus your attention on how the market behaves after the next inevitable pullback. That pullback, whenever it arrives, is going to answer a tremendous number of important questions. Here's a practical and actionable way to think about interpreting that behavior. If silver dips on some headline or profit-taking and then instantly gets bought aggressively, that behavior tells you that demand is impatient and urgent. Impatient demand means the market is genuinely tight. Tight markets don't give many second chances or clean re-entry opportunities. But if silver dips and the bounce is weak, sluggish, or unconvincing, that behavior tells you that demand is cautious and uncertain. Cautious demand often means the market might need more time to consolidate before the next serious leg higher. Either way, the dip itself is valuable information. Treat it like a message the market is sending you, not like a personal betrayal. And don't ignore or dismiss what I call the paper game moments. In highly stressed market phases, you can see sudden coordinated sell waves that appear at deliberately inconvenient times, often overnight or during thin trading hours, specifically designed to create maximum doubt and emotional pain. The goal is straightforward. Force emotional panic selling from weak hands, and then let price recover naturally once that forced selling is completely done. Understanding that this game exists and plays out repeatedly doesn't make you paranoid or conspiracy-minded. It makes you prepared and resilient. So here's a retention rule I personally live by and recommend. Assume that the next couple of weeks will be messy, volatile, and emotionally challenging. Assume there will be at least one significant move specifically designed to scare you out of your position. If you plan mentally for that in advance, you won't be surprised when it happens. And if you aren't surprised, you become dramatically harder to manipulate. Now here's the cliffhanger question you should be holding in your mind. What actually happens when the ratio cracks through a major level that everybody is watching obsessively? Because once a specific level becomes obvious and widely discussed, it becomes a magnet. Traders pile into positions anticipating the break. Stop-loss orders cluster just above or below that level. And liquidity hunting algorithms begin scanning for those clusters. The market very often does something extremely dramatic right at those levels. Either a violent continuation that blows through and doesn't look back, or a violent shakeout that triggers stops and reverses sharply. That critical moment is where prepared, disciplined people separate themselves completely from hopeful, emotional people. So if you're watching the ratio closely for 9, 8, and 7, don't only watch the number itself. Watch the reaction and the behavior around that number. Does price sprint through with no hesitation? Does it briefly tag the level and snap back aggressively? Does it churn and oscillate around it while underlying momentum stays hot? Those micro reactions are the behavioral fingerprints that reveal what's actually coming next. This is exactly why I want you connected on the inside of this community. Join the WhatsApp channel that's linked in the description for daily updates, key-level alerts, and real-time observations. And if you haven't already, subscribe to this channel right now. One click keeps you connected and informed when the market moves too fast for lengthy explanations. Here's another key structural piece that most people overlook: industrial demand. Silver isn't only an investment metal or a store of value. It's actively used, consumed, and built into products across dozens of industries. That means above-ground available silver inventory isn't nearly as large as casual observers assume. Some of that silver is permanently locked into manufactured products. Some is scattered across the world in small amounts. Some is physically uneconomic to recover quickly, even at higher prices. Meanwhile, gold is mostly hoarded, stored in vaults, and recycled efficiently. So if you get a moment where investor demand rises sharply at the same time that industrial demand stays steady or increases, silver can tighten dramatically fast. And when it tightens, price doesn't politely adjust in small increments. It can gap violently, spike overnight, and overshoot dramatically. Now I want to ask you two direct questions because your answers tell me what the broader crowd is thinking and feeling. First, do you personally believe that the next major silver surge will be driven primarily by momentum-chasing investors or by industrial buyers who genuinely can't afford to delay securing supply? Second, if the ratio actually hits 7-1, what do you think happens first? Does a physical shortage narrative dominate, or does a coordinated paper smash attempt to scare people out? Drop your honest take in the comments below. Also, here's a quick mid-video recommendation presented in a creative way. If you want to see real silver-related success stories, there's a link in the description to another channel that shares how real people actually made money, what expensive mistakes they avoided, and what specific strategies worked for them. Go subscribe there as well, because studying real wins and real lessons can dramatically sharpen your instincts. Back to chart logic, but explained in human terms. When you see multiple consecutive strong sessions of gains, markets almost always need some kind of breather. Not a crash or a reversal, just a breather. A localized high where price either chops sideways to digest gains or dips temporarily to cool momentum before the next run higher. That rest period is not a betrayal of the trend. It's structure doing exactly what healthy structure does. So if silver stalls or consolidates for a week, don't panic and assume the entire story is finished. The better and more important question is this: does it hold key support levels while it rests, or does it break down with serious force? If it holds support cleanly, that rest period can become the launch runway for the next powerful leg higher. Here's the cliffhanger you should keep actively in your head. The biggest and most explosive moves very often come immediately after the last easy-looking pullback. The market gives a dip that feels like relief, like immediate danger has passed, and strong, informed hands reload their positions. Then the next push higher is the one that finally brings in the emotional general public. That's exactly why chasing every single green candle is a trap. The cleaner and safer entries very often show up when the screen is red and your emotions are screaming at you loudly. If you don't plan ahead, you'll miss those entries. And if you plan poorly, you'll overreact emotionally. Now let's bring the supply bottleneck back into focus, because this is the structural engine under the hood driving everything. If most silver comes as a byproduct of base metal mining, then silver supply is tied directly to base metal economic cycles. If base metal mining activity slows due to lower demand or lower prices, silver supply can tighten even without anyone making a conscious decision to cut silver output. That's a weird and unusual dynamic, and it's exactly why silver can surprise people so dramatically. So picture this scenario: a weakening economy reduces base metal production, while simultaneous monetary anxiety boosts investment demand for silver as a safe haven. Supply becomes slow and constrained, while demand becomes fast and urgent. That mismatch is precisely where price explosions happen. This is where conversations about four-digit silver prices begin appearing, not because anyone can guarantee those levels, and not because you should build your entire financial life around one specific number, but because overshoots during repricing events can be extreme when a market is repricing under genuine stress. The first psychologically unreal level becomes a stepping stone, and the next levels start getting discussed because the crowd is desperately trying to map and understand a move it doesn't emotionally comprehend. But we need to be responsible and realistic here. If the market enters a genuine melt-up phase, the correct strategic posture changes. Early phase is about accumulation and building positions. Melt-up phase is about risk management and protection. That means trimming leverage, tightening your plan, and actively protecting the gains you've already earned. The goal is to stay in the game and survive, not to brag that you never took any profit. Now, a lot of people ask this reasonable question: why doesn't everyone just pile into silver if the opportunity is so obvious? Because the journey is absolutely brutal emotionally. Silver does not move in a calm, straight line. It moves like a coiled spring. It pops violently, then snaps back hard, then pops even harder. Most people simply cannot tolerate that experience. They buy the pop emotionally, and then sell the snapback in fear. Then they watch the next pop happen without them. So the discipline is simple to state, but extremely difficult to execute. Decide in advance what you're willing to hold through noise. Decide what you'll actively trade, and do not mix those two categories in a moment of panic. If you keep changing your identity mid-move, the market will charge you expensive tuition. Now let's talk about the ratio itself in practical terms. A ratio collapse can happen in two distinct ways: gold falling while silver holds relatively steady, or silver rising aggressively while gold holds or rises slowly. The second scenario is far more explosive for silver holders because it means both metals are fundamentally strong, but silver is dramatically stronger. That's when silver can feel like it's teleporting through price levels. If that's the environment we're entering, it explains why the conversation shifts from normal conservative targets to historical extremes, because the market is not trying to be polite or reasonable. It's trying to find a new equilibrium under a completely new set of supply and demand pressures. And if we do get a consolidation period, watch closely how the market behaves during it. Does the market dump and stay persistently weak, or does it dip and get bought instantly? Fast, aggressive buying on dips is a clear signal of hungry, urgent demand. Slow, lazy, unconvincing buying is a signal of exhaustion. The tape tells you clearly which one you're dealing with. Now, I want to speak directly to the person who's feeling overwhelmed by all of this. You don't need perfect timing. You need a plan that survives volatility. You need position sizing that lets you sleep at night. You need rules that stop you from doing something impulsive and stupid on a random red day. Because the biggest risk isn't that silver never goes higher. The biggest risk is that silver goes higher in a way that knocks you out of your position before the main move. That happens when you chase, overlever, and then panic on the first sharp pullback. So the best move right now is to stay rational. Build exposure in disciplined layers. Keep dry powder available if you're planning to add. Protect your base position if you're already up. And don't let a single candle convince you the entire story ended. And I genuinely want to hear from successful people watching this. If you've made money in markets, business, or any hustle, share one short lesson in the comments. It can be one sentence. What was the biggest mistake you stopped making? Your experience could lift someone else's confidence today. Now, to wrap the logic into one clean chain, silver supply is structurally inelastic because it's mostly byproduct. Demand can surge simultaneously from both investors and industry. Parabolic trends compress returns into shorter bursts. Major milestones can trigger rests, not endings. And the gold to silver ratio is the live scoreboard that tells you whether silver is leading. So here's exactly what I'm watching next. Whether the ratio continues compressing aggressively towards single digits, whether silver holds key support during any rest, and whether dips get bought aggressively. If those boxes stay checked, the next leg can surprise people who think the move is already done. And if you want me to keep tracking this journey with you, do the simple thing. Subscribe, comment OG John AG, and join the WhatsApp channel in the description for daily updates. Also, if you want to boost this community, share your success stories below. I read them, and so does everyone else who needs that extra push. Because if the ratio is truly collapsing back towards 7-1, the next chapter won't whisper. It'll hit fast, and it'll reward the prepared, not the emotional. So tell me in the comments, are you positioned? Are you waiting for a pullback? Or are you still on the sidelines watching?